Mark Potter from Babson College, and this is an introduction to mutual funds and asset allocation. One thing that we have to get squared away is that there are different types of mutual funds. And one of the most common type of mutual fund is called an open-ended mutual fund. Open-ended mutual funds are just that. Somebody comes up to a company and says, I would like to buy shares of the Fidelity Magellan Fund. And Fidelity says, sure, no problem. You give me some money and I will issue new shares. And that's an open-ended mutual fund. There were, and this data here comes from the Investment Company Institute, ICI.org webpage. And as of the end of 2017, there were about $49 trillion US invested in open-ended mutual funds. And you can see that it's divided out by geography. Most of those investments are in the United States and Europe, but a fair amount in Asia Pacific as well as other parts of the world. If you take a look at the US open-end fund total, 22.1 trillion, you can see that that consists of both mutual funds and exchange traded funds. There are also in the US closed-end funds, in which case there are a fixed number of shares of those mutual funds that are offered. So if you wanted to buy a share in a closed-end fund, you would need to find somebody who's selling their own shares in that same fund. And then just a tiny amount of money into unit investment trusts, which are like open-ended and closed-end funds in that they invest in underlying stocks and bonds, but they tend to have a fixed end point to them where the investments are liquidated and dispersed to the investors. And in terms of the importance of mutual funds own about 31% of United States stocks, 20% of US and foreign corporate bonds, and are also significant owners in other types of bonds as well. So there are a lot of investments, both in and out of the United States, put into mutual funds. And in turn, those mutual funds own a significant proportion of financing for companies, both equity and debt. In terms of looking at the households and individuals owning mutual funds, they're not all institutions. There are 102 million individuals within 57 million households who own mutual funds. On average, just under half the households in the US own mutual funds and have invested about 120,000. Also, what are these things for? As you might imagine, a lot of them are to save for retirement. So a significant proportion falls into that bucket. And a lot of the investments are wrapped into either IRA or DC plans. IRA stands for individual retirement accounts, and DCs are defined contribution plans. And so these are two different types of retirement plans or retirement programs. We can take a look at, or what this graphic shows, is the money coming in or going out of these open-ended mutual funds around the world in about the last 10 years. So we can see in 2008 that there were actually outflows, people taking their money out of mutual funds, both bonds and stock funds. But in each of the last 9 years or so, money has been flowing into mutual funds. All three categories. If we look just at the most recent year, 2017, that bond mutual funds received the highest amount of inflows. Then equity or stock mutual funds had a lot of money coming into them. And then finally, mutual funds that combine the two and other things also had significant amounts of inflows, a little less than bonds and stocks, but still significant. If we take a look at the number and types of funds around the world, if we look at the region, you can see that Europe has the highest number, followed by Asia Pacific. US is down here at about 9%. In terms of the type of fund, stock mutual funds or equity funds are only about a third of the total. Bonds are about 20%. And then you have this giant group called a mixed group. And so if we look down here at the notes, again, this comes from ICI.org, they can consist of balanced mutual funds. And that's a mutual fund that owns a fairly consistent debt and equity mix. You could see real estate funds come into this mix as well as guaranteed or protected funds. And these are funds whose goal is to, quote unquote, protect the principal. And we'll talk about each one of these a little bit later on. Okay, if we look a little bit more closely at the US mutual fund market, you can see that almost half of the investments are in stock mutual funds, 20% are in bonds, and the rest are in a mix. And so, let's see, what do we got here? We've got about 64%. So almost 2/3 of mutual funds in the United States ownership is fairly traditional stock and bond funds. If we look harder, though, we'll see that index funds have grown as a share of the market. So in 2007, mutual funds were worth in total a shade under 10 trillion, and 85% of that 10 trillion consisted of actively managed mutual funds, as opposed to index funds, which are created just to match a market. An actively managed fund tries to beat the market. In 2017, so the market's about twice the size. Actively managed funds are still significant, are still the largest category, but index funds now constitute a shade under 20%. Same thing with index ETFs, exchange traded funds. So that's a growth of 10 years ago or so, 15%, now 35% of the market. If we take a minute to try and see what drives people's need to invest in mutual funds or take money out of mutual funds, a lot of it has to do with chasing returns. So as the stock market has risen and fallen in the last 15 years or so, so has the money flowing in and out of mutual funds. So the red line is the stock market, and the blue chart is cash in or cash out of mutual funds. So we can see that they're fairly concurrent for about 15 years. That is, during this period, they pretty much follow each other. Then there's a bit of either a lagged effect or not as pronounced one way or another. So here the market is way up, but not a lot of new money into the stock market. Here, the stock market goes down, a lot of outflows. So you can see that it's sort of one way. Stock market goes way up. Yeah, there's some inflows, but not matched pound for pound like it had been in the past. On the flip side, market goes down a little bit, and then we have consistent downflows in spite of the market coming back. And so I'd say this is sort of a tale of kind of two periods. You have a period sort of pre-2011 where these things matched each other pretty well. Then post-2011, there's a lagged dampened effect on the upside. And on the downside, it's a magnified effect. And so we'll be taking a look at what's happening, why, and where's the money going. One place that the money is going is into bond funds. So you can see in at least the most recent year that a fairly consistent set of inflows have been going into bond mutual funds. So this is the bond market and money flowing into and out of bond funds. So the blue line is the rise and fall of the bond market return, and you can see that in this case it's a similar relationship, just maybe not as exact or pronounced. And we can see that prior to 2014, bond market is up. They'll have significant amounts of inflows. Bond market slows a little bit. The inflows are going to slow or reverse. Here, bond market is up. Lots of inflows. Bond market's doing okay. Inflows. Bond market down. Outflows. Up inflows. So there is a bit of a match. But again, more recently, even though the bond market has been fairly flat, the inflows have been pronounced. And my sense is that it's a bit of a prediction of things to come, and also a flight to safety. In other words, people are worried about the stock market, and so they put it in other places like gold, commodities, currencies, and in this case, bonds. This is just a slide that reinforces that previous chart on money flowing into index funds. Remember, index funds used to be about 15% of the total, and now they are about 35% of the total. And if we look at the cash flowing into index funds, you can see how it's really grown. It's fairly flat and fairly consistent till 2012, and it's grown significantly since then. Let's take a look for a minute at two unique types of investors, folks in their 60s and folks in their 20s. And these are pension plan asset allocation views, okay? So in other words, this is a 401k, which is a defined contribution pension plan that are run through companies around the United States. And it provides tax advantages for people who participate in them. So we can look and see how investors allocate their investments. This is called, in our world, is called asset allocation. And so let's say I'm a typical 401k plan participant in my 60s. I might not want to have all my money into stocks because I want to be diversified, but I might not want to have all of my money into a low risk investment because I need for my pension plan to grow. If I'm in my 60s, there's a good chance that it's going to last for, or I'm going to need it for at least 20 to 25 more years, hopefully. So how are my investments divided up? So a typical person in their 60s is going to have just a shade under 40% invested in equities or stocks. I'm going to have 17% invested in these things called target date funds, which are allocated to optimize a specific horizon. So if I'm in my 60s, maybe I want to retire in 10 years. So I have some of my money in a retirement plan that's known to have a horizon of 10 years. And that mutual fund manager understands that the people who are investing in that are going to start taking their money out in 10 years. So she's going to manage the mutual fund with that in mind. Maybe I'm going to have 6% of my money in other types of balanced funds. And we're going to look at a specific balanced fund in a couple minutes. Maybe I own some bond funds, money market funds, guaranteed investment contract or other stable value funds. These are things that are low risk that are designed to hold their value, not lose money. and then maybe own some direct stock, and then maybe some other stuff. So compare this set of investments with somebody in their 20s. So if I'm in my 20s, and remember this is a 401k plan, so if I'm in my 20s, this plan is going to exist for 40 or 50 years before I'm going to start drawing money out of it. And so where is that money going to go? What am I going to invest it in? Notice I'm going to have less of my money in equity. Now, that's a little unusual, right? You would think that younger folks might have more money invested in the stock market because they can ride out the roller coaster, the peaks and valleys of the nuances of the market over the next 40 or 50 years. But instead, folks in their 20s are starting to invest more in these target date funds. So if I'm in my 20s, maybe I have a mutual fund that's called the 2050 fund or the 2045 fund. These are and by their design, they're going to have more risk than the target date fund that the person in their 60s is going to have. Then I'm going to have less money into some of the low risk, low return categories. So let's take a look at a specific mutual fund. So the one that I elected, and this data comes from Fidelity and Morningstar, is called the Fidelity Asset Manager 20%. So this is a balanced fund that's designed to hold roughly 20% stocks, 80% bonds. And so folks who want to invest in this want to manage their risk by let's say I'm an investor, and let's say I want to own 20% stocks and 80% bonds. Well, I can make all those investments myself if I want to. I can go seek 20, if I have $100,000 to invest, I can go find $20,000 worth of stocks to buy and $80,000 worth of bonds to buy. But if I didn't have time to do that, I can just invest in this Fidelity Asset Manager 20% bond. You can see that Morningstar has recently given it 4 stars, that it's got average to above average return, low expenses, low risk. This fund has a total of about $5 billion invested in it. And everyone who invests in this, and what the fund company charges is about 0.53%. It has a turnover rate of 27%. That means year over year, about 27% of the portfolio turns over. What the fund managers elect to buy and sell is about 25% of the total fund per year. So that's going to be about, let's see, 27% of 5 billion. So a shade under 1.5 billion bonds and stocks get bought and sold by the fund managers in a typical year. If you wanted to buy one share of this mutual fund, it would cost you $13.35, but there's a minimum of $2,500 to invest. And we can see a map over time of how the mutual fund has performed relative to a few benchmarks. And we can see up here the specific returns over 10 years, 5 years, 3 year, 1 year, and then year to date. So this is a snapshot of a balanced fund, and let's look a little bit harder. So remember, this mutual fund, we want to buy it because we want somebody else to manage the asset allocation for us. So we see that there are 2 fund managers who are in charge of managing this $5 billion fund. And what they choose to do is divide it out, at least as of the most recent snapshot date, as roughly 15 to 20% domestic equities. Looks like we've got about 5 or 6% international equities. And then most of the fund, as the name implies, it's roughly 20% equity, roughly 80% bond, are in credit or bond investments. And they also give you a snapshot of some similar mutual funds from other companies to compare against. And if we look more closely at what this thing holds, we may want to divide it out by sector. So by sector meaning by industry. And so some of the investments are in the financial sector. That's a significant sector. Some are in companies that can't be defined within one sector. Looks like we have a fair amount of tech, healthcare, consumer discretionary, industrials, and down the line. So think about this as sort of an exposure matrix. Right? So this fund is more exposed to the financial industry and less exposed to the energy industry, nuances of those specific industries. And in terms of what they own, you can see that they own a fair amount of US Treasury securities. So they lend the US government money. Mortgages, mortgage pass-throughs, asset-backed securities, those are related to real estate. So are these right here, CMOs and the like. Investment grade credit, those are bonds. So we lend money to high quality companies, hence investment grade. Municipal bonds, we don't own a lot of those, so we don't lend cities and towns a lot of money. High yield, those are higher rates of return, but higher risk levels than investment grade. And then we have some investments in non-US or non-debt. And if we took a look at, remember this, we own both bonds and stocks. So what types of stocks do we own? Well, in general, if we put them in this is called a style grid, that they are large companies that we own, and they tend to be high growth. On the bond side, the credit quality tends to be medium, and interest rate sensitivity tends to be low. So these are just different ways to categorize and get our arms around the types of risks that we might bear if we elected to give these two fund managers our money to manage over time. What have we learned? Well, we know what the name of the fund is. We know what it's going to cost us. We know its return over time. We know its risk over time. And now we know a little bit more about what they're invested in. And then this slide shows us a lot more about what they're invested in so that we can see the types of exposures that we have. Maybe we want a higher interest rate degree of sensitivity. Maybe we want a lower interest rate degree of sensitivity. And then finally, we can take a look at some additional specifics in terms of region and specific holdings. So here in the upper left, it gives you the top 10 holdings. And so USTN, those are treasury notes. S&P 500 exchange traded funds, so it tries to mimic the performance of the S&P 500. It's just an index of large companies headquartered or located primarily in the United States. More treasuries, other equities. So MSCI Japan, that's just an index in Japan. Fannie Mae bonds, that's related to real estate. You can see the top 10 holdings and how they're divided up. You can also see country diversification, and we don't have a lot. We're choosing to invest the vast majority of this fund in US-based securities. And you can see that in a couple different ways here. So overall, the goal of this presentation is to talk a little bit about mutual funds, how they're constructed, how they exist in the United States and around the world, growth and growth drivers in the past 5 to 10 years. And then we picked a specific mutual fund, looked at that fund, its constitution, how it compares with other categories and other funds, and looks harder at this notion of asset allocation and how to describe the risk and potential return of the fund itself.